5,502 also. So during this 3 days period, by the process of buying this call option at 239.75 and 109.3, I have invested 17,000. My 17,000 will earn me profit of 1,142 at 8886 level. Similarly, it can give me the losses of 888 rupees at 5780. So this is the initial points for my profit and loss. During this period, it may oscillate between 5780 to 5886. If it goes above 5886, I may go to 5918 and 5886. In that case, my profit is going to increase. Fall below 5780 can drag it to 5748 and my liability is going to increase. Assume if I am just holding for the maximum anticipation of 6,164, then my profitability in this strategy will be 10,000. If it is fallen down to 5,500, my liability will be 1,000 rupees. It may be a distance dream. However, this target 1, target 2, target 3 level I can work out. Assume if I am getting some only target 3 level during the 3 days period, my reward is 3,700. If I fall down and gone down to the target 3 of which is 5686 level, then my liability will be 1,800 rupees. So 1:2 risk reward, it works out. So this is how you can trade in the option. So, and I also used to know what is the Greeks now. So you hit this button, you will say that now the net delta of buying a call option and put option of 5,700 each is having 0.38. Means 38% risk is associated with your 17,000 of money. Your 17,000 of money still has the risk associated 38%. And once this delta is going on increasing and comes to 0.8 level, so your profitability is there. From 38, if the Greek is reducing and goes to negative 0.727, your liability also is there. So each level of this thing you want. So suppose if I want that, no, I don't want this delta to be 0.38. I want this delta to be near 0 level. So what I can do? So here what I can do, I'll just have a scanning on this Greeks. I have a 0.38 of a positive Greeks, which I don't want. So I have a 0.38 of a positive delta. So I want this delta should be 0. So I will be hunting for one more option which will be having a delta minus 0.38. Assume I have one options, you can say 5,700 and put option, 750 put option, which is quoting at 127. So if I buy this option of 5750, which is having a delta of minus 0.35, so minus 0.35, so I can reduce my net delta to 0.05. Suppose if I am buying this one also. So let me evaluate the profit and losses. Assume I am buying one more put option of 5,750, 5750 put option. I am buying one lot. So if I buy this one and do a recalculate, my profit and liability is being recalculated. And if I go for a Greek analysis here, net Greek analysis, my net delta, which was 0.38, now reduced to 0.02. So 38% of risks has now reduced to 0.02. This process of trading is known as your delta neutral process of trading. And though your losses has means decreased and profitability also has been decreased, but you have a complete control over your money. Complete control over your money. So I am just going to show you specific trades. Here the first one trade I am going to show you for the month of September, what is the real trade we have taken. So that trade I am going to show you. Assume This is the trade is being initiated by us. So say this is the trade is being initiated by us. So this trade is being initiated on 23rd of August. The trade is as follows. Nifty future is being sold, one lot. 5,700 call option is being bought 250 quantities. 5,400 put option also being sold, one lot. And 5,800 call is going bought, two lots at the specified prices. This is what the prices of this trade is being entered. So I am just giving future sold, put option sold, 5,700 call option 250, 5,800 call option 100 quantity. This is being initially entered for the trade. Initially this trade is being entered. What happens in the next level? So that is also important. So what happens in the next level? What I did here, the 5,400 put option what we have sold, that I closed at 307.7 on the day of 28. So this is 23rd August it is being initiated, 28th it is being closed with a loss, and simultaneously
So just give me 1 minute. So it was running on battery.
is being bought at an average price of 67. At an average price of 67. So all these things I am doing. So this I have closed, this I have closed, and I have added this one position at 67. So by closing this one, though there was a loss of 8,250. Now, this strategy is being taken with a Greek neutral, delta neutral on the beginning day. After 4 or 5 days, again I am making it as a delta neutral or bringing to the delta to a near zero level. By this process, I have added 5,500 call option and booked the loss in the 5,400 and put option short, and I have holded the remaining positions. So by this process, what happens in the very next segment, very next day segment, which has on the 5/9/2013 on 5th of September, and started with 30th of August, 2nd of August, 30th of August, two lots of 5,500 call option is being closed. Again, 2nd of September, one lot of 5,500 call option is being closed. And 5th of September, all strategies are being closed. Everything is being closed, 5,500, 700, future, 5,800 call option, everything is being closed, and the closing prices I have given 5608. This is earlier is being closed. This is 94. This is 58. And here also we have 5,500 call option, which has different days it is being closed. So average price it has come down to 118 rupees. Average it is being closed. So if I can say this delta neutral strategy, keeping all risks into control, has earned 6,600 on the day of 5th September. 5th September, keeping a complete control over the losses, it has earned 6,600 on 5th September wherein it is being initiated on the 23rd of August. 23rd of the August. Same way, one more live contract also I am going to show you for this also. During the RBI policy and all those things, you can say 18th of September, one more strategy I am going to show you. 18th of September, this strategy has matured on the first day itself. What I have done here, one future of Nifty is being sold at 5879 and simultaneously 10 lots of 6,100 call option is being bought on an average of 25 rupees, 26 rupees. Same day, say all these trades has happened at 10 o'clock, 55, around 10:55 to 11 o'clock, and around 3:28, around 3:30 level, this same trade is being closed when Nifty has gone to 5942 and this call options has gone to 45 rupees, and this trade is being closed with a net profit of 6,145 rupees. This is also a delta neutral strategy with respect to the delta as net zero level. So all in all, if I can say, the strategies always gives you enough room to protect and to make money from the market. One more example also I am going to show you in the similar kind of strategy in a very uncertain market during this RBI policy and Federal Reserve policy date. So this is also on 19th of September, this strategy is being initiated with a future buy, Nifty future buy at 6152 and simultaneously 6,000 put options. I am buying 10 lots, 500 quantity at 32 rupees average. This is on the 19th of September, and on 20th of September I have closed this strategy. 20th of September I have closed this strategy. 6,000 put option which is being bought at 33 is being sold at 88, gives a profit of around 55 points in each lot. So 10 lots has given around 550 points. 550 points it has given in the 10 lots. And future which was being entered at 6158 is being closed at 5970 to 6158. So 188 points it has taken. 188 points it has taken. So if I can take a rough calculation, so 6 jars here, so for 360 points it has given, here about some 18,000 rupees gain. This strategy also is being given. Same day also I have taken some more speculative strategy on the State Bank of India. I have sold State Bank of India. This is the RBI policy date. Sold State Bank of India future at 1823. Bought 1900 call option at 21 rupees average and 1900 call option at 21 rupees average, 5 lots, and simultaneously 1800 put option is being bought 1 lot. So this also is being done with the delta as near zero. 1 lot put option is being bought, 1 future is being sold, 1900 call option for 5 lots is being bought at an average price of 21. And this strategy is being covered. So the put option which is being bought at 40 is being sold at 90. So 50 points it has given here. And the future which is being sold at 1818, it is being covered at 1753. So it is being covered here 1753. So 33 as 0 and 12 5 charge 80. So 80 plus 50. So 130 points the future and options has given. whereas the call options has gone in 4 rupees, so 21 minus 4, so 21 minus 4, 17 points I lost in each call option. So I was having 5 lots, so 5 lots has lost 85 points, made 135 points. So 85, if I can list it here, is 5, so 12 as 40. So 45 points gain it has given. 125 is the trading quantity, so around 5,600 it has given. So this strategy also delta neutral strategy being taken in a extreme case day when the outcome of a specific major event is expected, and with the delta to 0 I have initiated this strategy and it has given around 5,600 rupees gain. So I have shown you many such trades during this, and all these contract notes evidences we have been generated. So this is the tool being used behind this. So here, once you enter the trade, you know what is the net Greek of my strategy. Greek scanner you can utilize and bring your strategy to a near 0 level of Greek. Also, you can able to know what are the at different target points, anticipated target points based on the volatility, what will be your net profit and net loss. So this is how you should do the trade in the options, by keeping the option Greeks as.
So I have demonstrated you how you can form the Greek neutral strategies. So initial one example I have taken, wherein I have told you that initially I derived the Greek or delta to a near 0. Then after that, that doesn't mean that you are deriving so it will remain in that 0 level, it will change. So it has changed. I did some adjustments in that, and then after I have added few lots, so taken out some lots. Rather that lot also what is a loss making lot, so I have taken it out, introduced some new things in that. So then it is gradually I am just closing. That closing 1 lot, 2 lot, why I am making? I want that my Greek always my delta should be 0. So that is with that aim only 1 lot I have just closed it up, and finally I booked the profit. And similar way I have shown you another 3-4 strategies wherein, because the timing of that event was very important, so those times you can say RBI policy was there, federal policy was there, some extreme volatility has hit the market. So in a very quicker way and a very means a small time frame, we have just come out of that strategy. So that is that we book some profit, and one strategy also I have shown you, wherein we didn't make any profit, rather we got a chance to come out of that. So like that way you have seen many things. So this is the benefit of forming a Greek neutral strategy, and this is the best way you can protect your money. First you learn how to protect your money, then automatically the profit will come. But what happens in the real trade, people used to throw the money, and first they used to count for the losses, and when the profit comes, in a very quicker way they used to come out. So here the calculation goes in this way. Many traders used to ask me that in your volatility software, we are getting 30 points stop loss, 10 points target. So risk reward 30 into 1, 3:1. So risk reward they calculates for intraday trade, which is speculative in nature, which is not being managed with any Greek, which is not being neutralized with any factor. There they calculate the risk reward. While entering to the option, they never calculate that. Second category of trader I have encountered many times. They used to lose the money in the market. Once the 60-70% of money will be lost, they will say that, sir, I was trading, I lost some money, now I am doing the option trade. Why? No, options is trading in premiums, na? Because first I bought SBI in thousands, it is being lost, my principal is eroded, now I am doing same in the State Bank of India's options, so which is in 30 rupees. But my behavior towards the trading has not changed. I lost the money, then my behavior towards the trading is not changed. Only thing, instrument is being changed, and that is a dangerous phenomena. You don't do that first. Once you lost the money, without investigating that what mistake I did, they enter to the option trade. That doesn't give the profit, because that is whatever remaining is there, that also will go off. So that is second category. And third, whenever we are forming any option strategy, we never cares about why we are forming this strategy. Whether I have shown you one example of delta neutral. You can form vega neutral, you can form theta neutral, you can form vega neutral means volatility neutral, delta neutral means intrinsic value neutral, theta neutral means time value neutral. Till you expire, your time value will not lose. So these are the, you specify the objective. So these are the objectives if you set, and if you do the trades, definitely market is a winning venture. Trading is a winning venture. Trading is never being considered as a losing venture. It will be a losing venture if you don't care about your money. Because money will not speak. If you have 1 lakh rupees, it is depreciated by 50,000, will it speak? You will say that, no, I am dying, you don't misutilize me like this. So money will not speak. So you have to act on that. So this is what you have learned. So now we'll have a very short presentation on the products of Smart Finance. Then we'll have a tea break. Then I will take you to the next part of the learning.
As I just in the beginning told you, a lot of innovations are there in the domain of smart finance, and all of those innovations are available in the form of innovative products, in the form of books, DVDs, and software. So what are those, and how as a trader you can take advantage of those things? Just I'll take you across the various products available in our domain. For intraday traders, we have volatility-based intraday technique. We have dynamic Fibonacci, Elliott, and Gann principle. We have dynamic trend finding technique, and we have index decoupling intraday trading, pair trade trading technique. These are for the day traders we have brought. For future traders, we have beta decoupling technique and ratio proportion pair trade technique. For option traders, we have intraday option trading technique based on volatility and binomial option pricing model, intraday option arbitrage trade technique, and 22 hybrid option strategy for Indian traders. Next. How these are available for you is in the form of our products. You can see we have seen that option strategy simulator, that is for the option advanced traders. We have all these softwares on volatility, Gann, Fibonacci, and Elliott wave. We have integrated tool where all our softwares, total 18 softwares, are available in a single platform. You can get intraday as well as positional. Both the facilities are there. You have facility for commodity, currency, future, option, cash, everything in one single tool, integrated tool. We have various intraday and positional pair trade software also available in the package of future and option course. Next. Besides our products, we have certain seminar batches scheduled in this month of October. We have online batch and offline batch too. Offline batch will be happening in Chennai. The dates, as you can see, it will be on 20th of October, will be a Sunday, full day. We will have a theory session of 6 hours where Mr. Ranjan will give you all the theory lectures, derivations, methods, how he is deriving at the conclusion, all those things he will explain you in detail. That will be followed by another 3 days live market hour practice session. That will all happen in Chennai for the Chennai batch. We have a fee structure that will cost you 3,500 rupees for the entire 4 days session. 1 theory session and 3 practical sessions. Those 3 practical sessions will be through video conference, online it will happen. For online batch, from anywhere in the world you can join us, and it will be for 7 days. 4 days we have theory session and 3 days practice sessions. Each day 1 to 1.5 hour teaching will be there. The dates you can see, 23rd of October will be starting for the online batch. And the fee for that is 4,500 rupees. What are the topics we are going to learn in seminar? The 5 best proven intraday technique, that is our volatility, Gann, Fibonacci and Elliott wave, wise investment technique, simplified, simple and accurate way of trend recognition, and sure success option strategies. These are the topics in a nutshell. However, if you want to see what are the topics in detail and what will be the time, schedule, all those things, please visit our website. As you can see in the bottom, in the seminar link, we have flagged all detail. If you want to enroll also online in our site, you can do using that same link. Next. Now the courses, the books, DVDs and software available. Total number of 9 products are available in our domain. Investor course comes with 3 DVDs and 1 book on investment. Here we give you for Indian market with Indian market examples, and with a mathematical approach we prove how those techniques are accurate. So that is the investor course, which costs you 1,500 rupees only. Technical course, same way, we give you 3 DVDs and 1 book, cost 1,500. Elliott wave, we give you 3 DVDs and 1 book and 1 software, cost you 1,500. Software is a practical one. Fibonacci also the same, which cost you 1,500 with 3 DVDs, 1 book and 1 software practical. Now coming to Gann course. Gann course, we give you 3 DVDs and 1 book. Book contains 34 intraday trading techniques, and there will be 1 real-time data automated software. That costs you 3,500 rupees. Future and option pair trade software course, that costs 6,500, where we give you 3 DVDs and 1 book on future and option. The book contains from the basics of future and option and to the advanced concepts, including those 22 strategies, the way Mr. Ranjan has shown you just now few. The same way he has brought 22 future and option strategies. Those all strategies are being well programmed and put in this software of option strategy builder, not in this master future and course. Here you get the pair trade software. Pair trade software, already it is a known concept to many of you. We have discussed it many times here, even in many of our events. So that is being programmed in master F&O course. 3 DVDs and 1 book of 22 option strategies, and plus pair trade software comes in that. Next is the volatility intraday software, and mind it, pair trade is also a real-time software now, data automated. Volatility also is a real-time software, costs you 3,500 rupees. The best software, best tool for intraday trading. You can use for currency, commodity, future, option and cash intraday basically. That costs you 3,500, which comes with the software and 1 user manual and 1 ebook, which explains the details of the concept of volatility. Integrated tool, just I explained before, 18 tools are there, and it costs you 6,500. This too is a real-time data automated software. Number 9.1 is the latest tool, as just we have seen. Number of screenshot Mr. Ranjan has shown. The cost is 10,500 rupees. However, for today we are giving a discount that is 6,500 rupees. It is a purely real-time software. Along with that, many packages, many things will become in that package, and what are those? Just I will explain you after this slide. There is a price for the all courses. If you take separately, it costs you 26,500. However, with the bumper discount of 52%, we are availing it at the cost of 12,000. Mind it, number 9 product doesn't come. The option strategy builder doesn't come in this package of 12,000. 12,000 will give you the above 1 to 8 products. That will be totally 18 DVDs, 6 printed books, and all our softwares except that option strategy builder. Now, what is the content of books, DVDs? If you want to see, you please log on to our website. In the product link, we have very transparently put all the details. The books are being written by Mr. Ranjan and only by him. And the DVDs are his studio recorded lectures on those concepts. And all those concepts he has explained with the Indian market examples. So it's very easy for Indian traders to study it and follow it. Next. We have given our, previous slide please. We have given our Mumbai and Gujarat distributors, those who are watching us from outside Chennai, they can take down those numbers and they can contact those people. Next. Option strategy builder, these are the key features Mr. Ranjan has shown you just now. You can form options, any kind of option strategy. You can form Greek neutral strategy, advanced trend analyzer to inform you on weekly basis and monthly basis how the price is going to move. And the most important feature is that it will show you at those price points how your strategy will perform. Advanced Greek scanner will be available, and 22 strategies is being well programmed there. You can very well pre-calculate the loss, risk and profit potential of your strategy before entering the trade itself. These are the key benefits of the option strategy builder. Next. As just now I told you, we have the discount price. Instead of 10,500, if you are booking it today, it will cost you only 6,500. Because it is a data automated software, you have to pay yearly maintenance. That will be applicable from second year onwards and will cost you 3,500 per annum. And what are you getting in this package of 6,500? You are getting one software of option strategy builder. You'll get a 3 hours option course, how to use the software in the lecture of Mr. Ranjan only. Future and option trade book, just explained before, that book will come with 22 strategies. And 15 days exclusive support from Mr. Ranjan. By email he will send you how to follow the tool, what are the advantages in the current scenario, how to make better use of the tool, all those things. Then 2 exclusive pre-recorded lectures on option strategy for buyers. Every month it will come for the consecutive 3 months after your purchase. All this package comes at the cost of 6,500 if you are booking it today. Tomorrow onwards, 10,500. Next. Pair trade software that, as I explained, in Master Future and Option course it comes. It costs you 6,500 rupees. That gives you one book, Master's Key to Future and Option, as well as one pair trade software. And you can see the benefits we have given here. You can choose any number of 3 stocks or index and find the best pair in a click of mouse. You can pre-calculate your risk-reward ratio before entering the trade. And you get informed whether to hedge the pair trade or not before entering the position. If you want to see more feature about this tool, then we have flagged the screenshots of each and every tool in our site. In the product link you can see. We have a monthly subscription for this tool. This is 750 rupees only for 1 month. Next. Volatility software that works on the real-time data and real-time volatility estimation it will do. It gives you information on probability of going up and down before entering a trade. That also is an important feature. Dynamically use the Fibonacci principle when volatility is less than 20%. GAN it uses when volatility is above 20%. And when it is below 40%, and Elliott wave principle when volatility is above 40%. This selection and all, it is well programmed in the software. You do not have to do whether to use GAN or Elliott or Fibonacci. Automatically it is being programmed. So accordingly it uses and gives you the price forecasting. It does the comprehensive study of Elliott, Fibonacci and GAN method. These are all we have clubbed together while bringing this concept of volatility. That costs 3,500 per year. However, you can subscribe it for 1 month at the cost of only 500 rupees. Next. GAN course we have got. There we give you one book with 34 intraday techniques using GAN concept in Indian market, how it is applied. That is being explained in those 34 techniques being brought by Mr. Ranjan. Along with the book, you are getting 3 DVDs and 1 software. Software will give you these key features you can see. Trend analyzer is there using GAN method to know the intraday trend for instrument. Intraday and BTST tool using the authentic GAN study. This is the key feature of the software. This tool too is available at the cost of 500 rupees. So these are all about our product detail. If you have any query regarding our product, please ask me. except asking me for discount. So monthly subscription we have got for our products for like GAN, where you can take it with a cost of 500 rupees per month. You can take our volatility product with a cost of 500 rupees per month. You can take our pair trade also with a monthly subscription. Will cost you 750 rupees only. You can take our integrated tool too for a month. That will cost you 750 rupees only. Option strategy regretted, no monthly subscription available. Any questions, sir? Yes, it doesn't have pair trade, it doesn't have your option strategy. It is having total 18 number of tools, all your GAN tools, square of 9, square of 12, it is having Elliott, Fibonacci. Option strategy it will not be. It has volatility. It has volatility. Yes, sir. Sir, for commodities also you can use it. Yes, volatility you can very well use. In volatility we have kept special window for commodity. Yes, of course for index you can. Yes, of course, volatility is having a special window for commodity and it is real time. That will get connected to our server. You need not have to do anything. You have to open the software. Sorry? It will be connected to our server. That is our developers can only tell. From our server it will come to you. So you need not have to give any input and all. Anything else? Otherwise how it will give you, sir? Obviously from M6 only. Integrated tools are cost 6,500 for 1 year. For 1 month 750 only. 1 month 750. Anything else, sir? Now we'll retire for a tea break, and after 10 minutes again Mr. Ranjan will continue, and last half an hour you can ask your valuable questions related to the concepts only, not to the product. If further you have any product query, you can come right now in the tea break. We have our counter here, you can ask us. Thank you so much.
Nifty into 45, which is coming to 0.25. So this is the degree factor for 45 days. Suppose if my price is 100 and I need 45 degrees support trend line, then how I can proceed? So I'll take the square root of 100, which comes to 10. So this 10 will be less from 0.25, which will give me 9.75. And this 9.75 I will take a double multiple or whole square. This will give me the price point through which the 45 degree support trend line will cross. If I want the 45 degree resistance trend line, how you can provide me this information? Same way, square root of 100 you will take, which is 10. So 10 added with 0.25, which is the factor, and the entire thing you will be taking the whole square. So which will be giving us the 45 degree resistance trend line. So like this way we can calculate the trend lines and we can decide on the pricing part. So this says 95 rupees and 06 is a price point through which our 45 degree support trend line will pass through. Same way, if I just take the 10 added with 0.25, so 10.25, so if I take a square of this, then it says that square of this, if I am taking in terms of square, then I will be getting my resistance trend line, 45 degree resistance trend line will pass through 105.06. So for every degree, there is every trend line, there is a degree. For every degree, there is a degree factor, and using any price point, either high, low or high, low, midpoint or closing price, you can able to find out to which price point that respective trend line will pass through. So herein, say, I'm just taking one small example. So suppose I have taken Nifty. Today I am recording post market hour 4 o'clock Friday, October 4, 2013. So I have just taken Nifty first 1 hour price point. So 9:15 to 10:15 price point I have taken. 9:15 to 10:15 price points I have taken here. So 10:15 price point I am just going to take. So I will be seeing that what is the high, low and other things it has made. So 9:15 itself it made the low 5941.4. So record this one 5941.4, and during this period of 9:15 to 10:15 period, on 10:15 time it has made a high of 5999.4. So 5994.99.4. So from 0.6 points deviated from the 6000. So 59994 we have taken here also 59994. 599.4. So this is the high low for the first 1 hour of the trade. So I'll be just taking the midpoint of this. Midpoint of this, because midpoint is a neutral point. Midpoint is a neutral point. It is neither high nor low. So it is a midpoint is the neutral point. 5970 is the midpoint. So I'm just taking 5970.4 midpoint and 5970.4. So for today, it tells me for 1 hour data, once I take into confidence, it tells me the third trend line, which is 1/4. Here this side is resistances, this side we are deriving the supports. Third trend line, so it says that whenever Nifty crosses 5983, we'll be buying Nifty for a maximum expectation of 6045. Same time, whenever Nifty fall down below 5958, we should sell Nifty for a minimum expectation of 5897. This is what it says. So this is 1 hour's data we have taken. Very next hour, it has fallen down 5986.6. So after reaching that high, it is falling down. So after touching this 5999.4, it is falling down. Obviously, it should come through this 5983. However, it has already touched 5994 level, so 5999 level. So which is my 26.25. This level it has crossed, and from there it is retracing back. So I'll not buy the Nifty at this point of time as a swing trader, because though I have done a calculation from 5970, current price is ruling above that, but this is in a sliding trend, so I'll not buy at this point of time. Rather, I will wait for 5958. If this 5958 breakout given, then I can think of selling it. So this first 920 candle, it has not given us. 925 candle also it has not given us. 930, and in fact around 935, it has given us the breakout. So around 935 you got the breakout. Around 935 you got the breakout.
It's a 1035.
You got the breakout to sell Nifty at 5958. Your maximum expectation is 5897. So let me see what you have achieved for the day. So for the day, after breaking that one, around 1045, we have touched the low 5926. Maybe it is for a couple of seconds. 5926 we have touched. So 5926, which says that you have penetrated this 45-degree support line and gone to 5926, and from there you have reversed back. So 58 to 26, that many points you have made profit in the Nifty. If you have taken first 1 hour data 9:15 to 10:15 for your period. So this is what I have shown you for the Nifty. Let me show you some more beautiful use of this particular method. So we will be finding out the trend now. So I have just taken a back testing of this one. So I have taken the date wise. I have taken Axis Bank future 17th September to 1st October. 17th September to 1st October I have taken, and 17th data I will estimate for 18th. I am going to draw this same Gann angle with the last traded price. Last traded price is 1058. So 1058, 17th last traded price is 1058. The levels what we will be calculating will be valid for 18th September. This is what for the trend. So for 18th September, so third trend line, it says that 1063 above my trend will be up, and it can maximum take me to 1089. If 18th September opening happens above 1063, I can go till 1089. Same way, if the opening happens in the opposite order at, say, if the opening happens in the opposite order, my last traded price for 17th is 1058. So 1058 reference I have taken, and from there I have just calculated this one. And if I am just 1058, yes, here. So if my opening happens at 1052 on 18th on 18th of September, then my trend will be down, and which can bring me to 1026. So this is the range for the day. So this column M and N focuses for the range for the day. Maximum 1089, minimum 1026. Trend breakout should give above 1063 or 1053. So this is what it has happened. So here on 18th, you opened at 1060, attended a high 1094, low was 53.8. Low was 53.8. Definitely downtrend has not started, and the last target you have calculated 1089. It has very much penetrated. So 18th, you have 17th data you have taken. 18th September data says that your trend calculation was perfect to the 100% extent. So this is what you have calculated, and this is what you have got. Same way, I'm just going to take for the 19th. 19th, this is 100% you have got. So 19th, high was 1182 and 1146. 1182 and 1186, and opening was 1159. So here you have taken a reference from 1090 and calculated this thing. So my next level will be, I am taking 1126 to 1062. 1126, which is 19th of September, I am expecting 1126 to 1062. However, I have opened at 1159. So what I have to do here, the reference what I have taken from 1094, since I have opened higher, I'll change it. 1159 I'll make, because almost all the levels I have penetrated. So after changing, it is telling 1191 to 1126 will be my new level. So between that also, these are the intermediate levels are there. So almost you can say 19th high and low if I'll take, high and low if I'll consider. Low side you have not given the breakout, higher side till 1182 you have come, 1182 you have come. So till 45 degree you can say, I'm just giving a weightage that 60% of success you have got based on the trend, and no stop loss actions has taken place. Again for 20th, this is for the 20th. 20th, what are the levels we are calculating here? So 20th, our calculations is varying for 1189 to 1124, and 20th also opening was 1163, gone to 1168, so 1163. So here 20th, slightly above you have opened off, and 68 you have gone, just 26% you have achieved. Then you have broken this all levels, broken the level of 1151, and you have achieved 1060, which is 1060, and settled at 1116. So 20th, this is our anticipation. So we have anticipated till 1124, we have achieved till 1116. So 1116, and so here too also I have got 100% on this. So if I just go on calculating on this order for trend part, we are not initiating any trade. Taking the previous day's last traded price, applying it on the Gann angle, this is upper side angles, this is the lower side angles, and we are getting the trends at third trend line. Third trend line price point is for our trend confirmation for uptrend and downtrend, and based on this I have just given you for the Axis Bank 17th September to 1st October. 17th September to 1st October, in 80% of days, 80% of days, it is a straightforward calculation in front of you. You can also calculate, test it with any stock also. In 80% of days, calculation of the trend was perfect to the tune of 80% to 100%. And remaining days, when there is a huge gap up or gap down happens, those days also we have achieved 50 to 60% of the success in our calculation of trend. I am not talking about the prediction based on the calculation. With this simple mathematical calculation, you have achieved this much of successes. You can test it with same way of square root of number added with degree factor, whole square root of number subtracted from degree factor, and again taken a whole square. This is the degrees, 11 trend lines. This is the degree associated with 11 trend lines. These are the degree factors associated with those trend lines. And these are the resistances and support calculations based on that. So third trend lines crossover, for intraday we will make the trade. Third trend line crossover, based on the closing price if we are deriving, we will find out that is the trend for that day. So this is the two different use of GAN angle I have told. So based on the same concept, we have also and little bit of a higher concept of WD GAN. We have devised a fantastic product on the GAN's method. You find out the trend before you enter the trade. You just have to select a stock of your choice. Though it has not taken directly the GAN angle, it has taken many other GAN principles for that. So here you select a future or index, whatever you wish to trade, and you need to just load this data and hit the calculate button. Once you do this, what happens? The tool itself does the calculation. Where is your minor of trend? Where trend confirmation it comes? What is the volatility? What is the expected volatility? Everything it gives based on that principle. And the GAN tool also, we have given a separate tool for the intraday trade, because estimation of trend and calculation of the trade is entirely different. And for that we have given the here index future. You can just choose load data. So once the data will be loaded, you need to give the information whether it is the first hour's data or second hour's data. If I am telling yes, first hour's data, then it will calculate by at what price, what will be your stop loss, and what will be the targets. And if I am sell at what price, stop loss and targets. So this is based on the GAN's principle. I have shown you a white paper back tested result for Axis Bank. So result for Axis Bank. So 2 days, 3 days I have shown you. For remaining days, if you can test it, you can find out more.
Fine. So this is based on the GAN angle principle. So the literature which is being given to you in the CD, that every one of you is being given with one CD which has 7 hours of lecture, 7 to 8 hours of lecture on different subjects. Because here the scope is very limited, I can able to take some 2 or 3 principles. But there we have given you how scientifically you can use the technical analysis, how scientifically you can use those GAN principle and its finest calculations. Like each lecture will be 1 hour 45 minutes like that. So if you can go through that, so you will get more clarity on those calculation parts. So I have not given more stress on the calculation, how it is being calculated, how square root is being taken. So all those things in the finest way we have given in that presentation, so that you can follow it after this session. So any questions on these two concepts of option strategy and GAN angle? Then I can go to that other part of volatility and other things. Yes. See, once you form one strategy at a particular time, so you derive that Greeks either delta or vega or gamma or theta based on your requirement, you derive it to 0. Say you are deriving it to 0. Next what happens, around 3:15, either your profit will be at a profit or loss, that doesn't matter. So say I am just holding it for 3 days. So today day ends. and I'll recalculate it. I'll hit the button to recalculate what is my net Greek now. Suppose I have taken with 0, it has gone to suppose 0.16 positive. So I can introduce one more put option to bring it to 0. So next day, suppose again I did the calculation after an hour of market open or after 2 hours of market open. My strategy either will be profit or loss. So that time I can find out that yes, my Greeks has already changed, which as I kept it 0, it is again gone to suppose 0.46 or gone to negative. If it is in profit, so in that time I will not advise you to add many lots there. Rather, whatever the profitable component is there, watch out, because you are getting a scanner wherein all strikes Greek you are getting. So just think out that if I can book one profit in one particular lot, whether my Greek will come to 0, so book the profit in that. So the very idea is, till I hold the strategy, the day I initiate, till the third day when I am anticipating my targets will come and I will come out, till that point. So give some sufficient time. Don't make it within 5 minutes, 10 minutes, 20 minutes like that. Because that time some speculations will be there. You'll get little up, little down like that. But rather it will be good that if you can do it in the day end around 3:15, so 15 minutes will be there in your hand to initiate a trade. So do some adjustments, and next day you can just, after some 2 hours or 3 hours, estimate your strategy and do some adjustment if you want, or you can just reduce one strategy. So it is not a frequent trade. Rather you can say the frequency of estimating that, if you can keep it some 3 to 4 hours or day end. If your projection is for 5 days, so day end around 3:15 if you are doing, it is better. Yes. Now see, I have told you one principle here on the swing trading, which is not having any role with the GAN. Suppose you tossed a Nifty, you have taken a reading from 5,999, which is very close to 6,000, and you have taken a reading when the low was recorded 5,942. That the trailing 1 hour from 9:15 to 10:15 period you have taken. So what happened during that? After touching that 599 means 6,000 level and it is retracing back, definitely it will pass through that 5983 which has come as per your calculation. So question is whether I should buy at that time or I should wait for the sell entry to come, because I have tossed a level of 6,000, I have tossed a level of 5941. Now my calculation says that at 5983 I must buy, at 5958 I should sell. So now there is the only one puzzle or confusion for me, whether I should buy at that time if it comes to 5983 or I should wait for the sell entry. So swing trading principle says that once you are given a upper trend breakout and couple of targets has happened, because that 5999 or 6,000 also one of the target, you are taking the reading from midpoint. So after touching a target in the higher side, you are retracing back, you are surrendering that trend, and the price is now aiming for a new trend. So your new trend breakout will happen from the 5958. So there I will suggest that you should not buy, rather wait for the downtrend to break out. Suppose downtrend has not given you breakout. In this case it has given. Suppose it is not giving the breakout for 1 hour period. You have waited for 1 hour and 5958 has not come. So in that case what you can do, you just take a fresh data, which is the trailing 1 hour. You may be at 12 o'clock, so 11 to 12, what is the high low it has made, and take that fresh data, do a fresh calculation, get a fresh level, and accordingly take a chance. Okay. So here the very idea of this GAN angle principle is, not only GAN angle, also Fibonacci or Elliott, any principle is, if you are an intraday trader, don't ever ignore the swing action. Swing is just like an action of your demand and supply. The demand has propelled, you touched the level of 6,000, then the supply has emerged and it is now breaking it. So you wait for the breakout of the downtrend. Rather, don't be emotional and enter into the uptrend. That is a that is a technique of swing trading. That is not having any relationship with the means GAN angle. GAN angle is a straightforward calculation. Any other question? You can use. Yes, sir? See, once you are going for the technical analysis, I will split it into the 2 to 3 parts. The statistical studies, like your MACD, moving averages, oscillators, whatever you are saying, that is just the statistical studies. Statistical studies where it fails. You take a past data, you investigate and estimate for the future. Okay. So that is the failure point of the statistical studies. Once you are coming for a chart and pattern studies, like you want to study a pattern, say it is a candlestick pattern or a linear pattern wherein you just say that it is head and shoulder. You may say it is a head and shoulder. I may say it is a triple top. Somebody else may say that no, it is not from a head and shoulder pattern at all. Because there are a lot of ambiguities are there. And if you just go through some 10 literatures on the head and shoulder, just have a web search and find out 10 different articles will give you 10 different ways where they interpret the neckline. The reason it is being evolved from a traders community. It is not being evolved from an academic way. That is the loophole of the chart and pattern. And when it comes to the means indicators and oscillators, those techniques are being taken from the past data into investigation, and that is valid for a prolonged in the equal amount of, suppose if I am taking for 3 months data into investigation, then my outcome will be for a 3 months period in the ahead. But when you take it is for a smaller time frame, which is intraday, so that doesn't perform well. And the third part of your study, which is Fibonacci, GAN and Elliott, all three are the means related to each other. So what you did here, you have just taken a price point for your reference. 5,970 is a midpoint for a particular 1 hour. Then the roll of 5,970 is ended there. You are drawing 11 trend lines at different angles. So your historical fact has not come into picture. When you are drawing for the retracement, you take a price range of a particular high and low. So from there, the high and low role is ended. Now the retracement ratio will play the role. Suppose you are drawing a Elliott wave. You have taken a pre-priced high and low price range. From there, you have just applied the Fibonacci principle with certain restrictions and rules, and you have drawn 1, 2, 3, 4, 5 for ABC. So there, the role of a past price action is ending as soon as you got some input. The future actions is being calculated or found based on a particular rule fixed by the Fibonacci, GAN or Elliott. Definitely more. Definitely more. In terms of percentage, if I will tell you 100%, you will be very happy. If I will tell you 50%, you will be disappointed. So that percentage is a very ambiguous term. So I never rely on those percentage terms. But as far my experience says, if you say out of 10 trades, if you are getting 5 trades success as per your study of lines or study of graphs, charts and all indicators, then I can give you a weightage of, you can get some 7 to 8 trades success as per the Fibonacci, GAN and Elliott. So that way you can just fix off the percentage whatever you want. But to please you, I can say 100%. That is a different aspect. See, whenever I talk about a option strategy, my aim is entirely different. My objective is entirely different. My objective is to protect my capital, to earn the money during that period of time. When I talk about the intraday, there I need a rational principle to identify a trend. I need a rational principle which can give me a buy entry and sell entry. Because buy entry, sell entry, any kid can give you. Suppose if you are asking a kid who doesn't know, he knows only the utterance of numbers, if you say, tell me the resistance and support of State Bank of India, he will tell you one number. So that is what happens here. Because 99% of the cases, you can find out that the utterance of the resistance or supports never performs, never happens through a rational process. Here you do a calculation as per the Gann's principle. Because these calculations are not hidden, it is just a square root, it is just a double square of that. And the trend lines also is not restricted, because this 11 trend lines is not defined by me, it is by WD Gann. So you do the calculations and have a comparison with that. Yeah, you can do anything. No, the advantages are many, because thing is that as one of our participants was telling me that he was very confident on the Nifty. He is doing the trades in the Nifty, so it's not wrong. If I'll tell you that somebody says that I will be putting a stop loss 5 point below, profit at 10 point above, so it pleases his mind. His mind is being pleased by that. Yes, 5 point loss I can take, 10 point profit I will take. So there I will say that you should not follow any of this method, because you have already formulated your method and you have already rigid on that method, so there is no point in following any method. So whenever you are saying that yes, buying a naked call and put option can reduce the trade, and it will also gives me very good profit, that if it goes by 100%, my money will be double and triple off. Same way also it can come to zero, and it can take all the money, whatever you have invested. And that is a other say also you can say. Reducing the job, why should I? Because there is a mentality differs, because it is a trader's mentality. See, have you ever seen anybody has become a doctor without going for a MBBS course? I'll give you a very vague example. Anybody become an engineer in this room who has not studied engineering for 4 years? So, to become a carpenter, plumber also, people have taken the skills for that. So if we could have thought, if our ancestor would have thought that, no, there is no need of thing, whatever the life is there, let it go on, then we will be living in that same bullock cart age. We could not have invented the aircraft, we could not have thought in that aspect. So here my approach is, think beyond that. How you will, if trading is not an easy task, don't think that trading is a very easy, because my point is, as I told you in before some time also, money is a lifeless entity. Money never shouts back. If you have 10 lakhs, if you have lost 5 lakhs out of that, remaining 5 lakhs will not revolt. But who will revolt? If your wife has seen that 10 lakhs bank balance has gone down to 5 lakhs, then that wife will revolt. Where you have spent that. Because money is a lifeless entity which never reacts. So for that reason only, we took all the trading activities, not only trading activities, we took all the expenditures into granted, and we used to think that that expenditure is genuine. That trick is genuine. Because if I buy a call option and made some 5 rupees out of that, I said that okay, it is genuine. But I will say that not, it is wrong. Why you? First question is that I will be taking in the second presentation how to buy a call option and put option also. Why you buy that call option? You must have an answer for that. Why you buy that particular strike option? You must have an answer for that. If you are booking a profit at a, suppose 5 rupees or 10 rupees above, you must have an answer for that. If you are booking a stop loss, putting a stop loss also, you must have an answer for that. If you have all these things, 4 things answer in your hand, then I can classify that yes, this trader is aiming from the market and going to stay in the market for long run. And if the trader doesn't have this particular 4 answers of my 4 questions, why he is buying a call option, why he is putting a stop loss at that point, why he is exiting the trade at that level, then I can say that the trader has entered to the market just the aim to gamble something and get some money out of that. That is the difference between a rational trader and a gambler. Gambler doesn't have a direction. Gambler doesn't have a way or vision to achieve, but trader has a vision. Because if you think that this trading is so easy, why the mutual funds are recruiting only IIM fellows and very good fellows for fund manager? Why not you and me? We can go and do wonders there. We can go there, buy only call options, 5 lakh slots, 10 rupees increased every day, 100% return, and NAV will be jumping like anything. That fund house fellows will just keep us like Maple. Does they do that? No. And they stay in the market for long run. Who quits the market? Those who underestimate the market. And always in all seminars I used to tell, this seminar also I am repeating. If you are a trader, you are holding the tail of a tiger. Last time also I told the same thing. You are holding the tail of the tiger. If tiger is a very powerful animal and you are holding the tail of that. If you release the tail, which is your money, if you open up your hand and make it a free jump, like your free call and put buy, then that tiger will kill you. As long as you hold that tail, you are safe. Because tiger turns to left side, you will also change your direction. So you will not be being killed on that event. The moment you release it, you will be gone. Fine. So I'll just go to the next part of my presentation, which is the volatility and option trading also I'll take in that. Option intraday trading also I'll take in that.
In this part of my presentation, I am going to describe how you can do the intraday trade using volatility concept. Also, I will be showing you how you can do the intraday trade in options. So during my presentation, I will be describing the volatility and Fibonacci principle. By this you will be finding the trend and you will be doing the trade forecast. One method I have already explained in the Gann's presentation, wherein also you are finding the trend as for the Gann angle principle. You are also using that principle, you are initiating the trades. So once you accommodate volatility with the Fibonacci principle or Gann principle or Elliott principle, these three existing principle becomes very powerful, and that principle becomes a dynamic principle. To recall you here, I just want to remind you all the seminarians that the dynamic Fibonacci principle, dynamic Gann principle and dynamic Elliott wave principle is a innovation of smart finance. So these are the techniques being innovated by us. It was not before, it is not being documented in any of the books. So here in this presentation you will be seeing that how I will be accommodating the volatility with the Fibonacci principle. So Fibonacci retracement principle basically. So what I will be doing here, I will be calculating the volatility. I will be calculating the expected price range as per the volatility. Then I will be finding out the trend and trade entry point and profit booking, and I will do the back testing also. So for this, I'll just go back to this. I have taken from 26th July to 3rd October data, so that I'll be just analyzing and finding out those levels. Whether I am correct or not, that also I can able to find out from this. So what I did here, I have taken high, low, close and last traded price for this, so that I can do some simulations and see that whether my calculation works properly or not. So what I did here, I have just taken a LN parameter, which is the last traded price I will be taking for confidence. So current last traded price minus current last traded price divided by the previous last traded price. By this process I have found out the LN. This is also logarithmic value I have taken for that. So this is also known as the absolute return. Then I will be taking the square of this. So this says that the square absolute return. So for this I will be taking for 10 days. 1, 2, 3, 4, 5, 6, 7, 8, 9. So 10 days, the first day is empty. So 9 days is coming in the first record. So by this process we are finding out ln square. Then we will be taking the average of ln square minus average of ln square values or absolute return square values minus average of the absolute return values whole square. So this part will give us the average of ln square values and average of ln values whole square. So this is part is required for our calculation of volatility. Then what we have to do, we have to,
I'll just forward it a little bit because same calculation already I have in a other part.
take the square root of that. Square root of, so after taking here, so I'll just go back to this one will be more clear. So whatever the values we are getting here, so we got ln average, ln square average, then variance, so then square root of this one. So by this process also we got the volatility. So daily volatility, say for this example of 6th September to 20th September data for Nifty, it says that daily volatility is 1.68. That means on following day, the Nifty is going to give us a swing of 1.68%, but we never know whether it will go up or it will come down. But volatility says this much of oscillations are expected in the Nifty. Then after we have to use the Fibonacci retracement principles. So Fibonacci retracement principle starts with the ratios, as all of you will be knowing. 236, 0.382, 0.5, 0.618, 0.786, 0.786, and 0.888, 0.888, and 1 and 1.236. These are the 1.618. These are the Fibonacci ratios associated with the retracement. So we got a price range here 101. So 22.236 of this 101 rupees comes to 23 rupees. So my last traded was 6040 here, 6040 here. So next day, if it is going above 6071, then my trend is in the upward direction. It is moving in the upward direction. If it is opens at 6023 or below, I'll say that my trend is started downward direction. But this 0.236 never confirms the trend as long as you have not touched this 0.382. So 0.382 says that once we are going above 6085, our trend is up, and once we are coming to 6008, our trend will be down. Once we cross 6085, we have all probability to touch 6148. If we slip below 6008, we have all probability to touch 5945. So this is what the volatility and Fibonacci principle. I have calculated the volatility. I have calculated the price range as per the volatility. Using that price range with the Fibonacci ratios, I have calculated the uptrend level and the maximum target what I can get and all other targets. And based on that price range what I have calculated, from there downtrend level and the downmost where I can go. So all these things I have calculated. So what is the success ratio of this method? So if I'll just go for a back testing of 26th July to 3rd October for October Nifty future contract, back testing of this. Suppose this is the day, the 5651 was the 5651 was the actual price. Based on that, we have calculated that our buy entry is at 5662, sell entry at 5639, but we have opened at 5673. So in this case, what will happen once we are opening at 5673.8, so which is beyond our target also. So you can say above one target we are opening. So we do not know where we will open. So we have calculated as per the price point, but we have opened above our entry price, or we may open below our entry price also. In that case, you change this price point to our opening price. So we got a new level. So this new level says that above 5686 we should purchase, till 5728 we can get it. If 5660 is broken, then we can go till 5618, and in between we will get 5630. If you can just see the data here, data points of high, low and last traded price. 5674 you have opened, 5769.7 you have achieved. Downside also 5630.85 it is achieved, and last traded is 5673. So this says that in the both upper side we have estimated till 5728, everything we got. Downside we have estimated till 5618, we got it till 5630, and settled at 5673 point something. Very next day, so we'll be taking this value as a input, and we'll be calculating for the 13th August. So 13th August we have to calculate. So 13th August we have estimated to buy above 5686. 5729 will be our maximum target. Sell below 5660, and 5617 will be our minimum target. So we opened at 5668, touched a high of 5776. So almost everything we have achieved. 5650 was the low of the day. So assuming this particular day of 13th August, if the stop loss is triggering also, suppose our opening was 567, gone till 5650, and in fact these price points I do recall that it has happened in the first hour of the trade. Then you have got a breakout above 5686, and closing price suggests that you have achieved all the targets in the one direction. And even though if you enter to a trade, and if you are considering that yes, stop loss is being triggered, so 26 point of stop loss is being triggered, however you made a very good money of 45 to 50 points if you are reversing the trade at the triggering point. So by this process, if I'll go on estimating from July to 3rd of August, so out of this, so 12 minus 47, so near about 25 trading days, 35 trading days, almost 35 trading days of investigation says that you have achieved excellent successes around 21 trading days. You got partial successes around 6 to 7 days, and remaining days you had the triggering of stop loss or partial targets is being achieved. So this is the method of volatility. So backtesting result of the volatility based on this data given you more than 60 to 70% of accuracy in this, and this too also you can backtest. You can backtest with any number of data. Calculate the volatility, calculate the price range, use the Fibonacci proportion on that price range, and do the estimation for the coming day. Now I'll be just moving to the next part, the option trading techniques, intraday option trading technique as per the volatility. First, we have to identify the current trend in the market. Then we need to decide upon a strike, and we need to analyze the implied volatility option and the premium behavior at different strikes. So for that we need the help of a particular software. I'm going to demonstrate with our intraday option trading software. I too also will show you some of the trading contract notes of the month of September. So here I am just loading the symbol here, index Nifty, and I am just loading this data. Once this data is loaded, then only I will get some clarity on the front of data, and I will get all my strikes and everything will be get loaded here. Then I will do some analysis and I will get those outcomes of my analysis. So I am just loading the data. Data load is completed. I got the signal test. Yes, data loaded is being completed. I will be analyzing the future here. So current future price if we can take into confidence. So I am just going for the market has closed now. So for the day of 4th October, market has closed, but let me see what is the price point it has been closed. So what is the price point it has been closed? So let me see this one. So Nifty, so it has been closed at 5957 level. So this tool gives me the information above 5976 my trend is up, and below 5937 my trend will be down, and I am at 5957 level. I am at 5957 level. So 5957 level I am at. So my uptrend is at 5976 and my downtrend starts at 5937 as per the volatility. So suppose if I am near to the uptrend, if my price is near to the uptrend, then I will be choosing the strike close near to my uptrend price. So definitely my attention will go to the 5950 call option. So I will be going to 5950 call option. So 5950 call option, which is quoting at 159.5, and I will be just analyzing the premium. This says that I can buy the call option at 171, keeping a stop loss of 149, and these are the targets for the day. If my price comes closer near to the 5937 level, then I can think of the put option, the same strike 5950, and I can just analyze the option. Then it will say that the put option which is quoting at 152 now, I can buy at 161, keeping a stop loss of 144.6, and this will be my targets in the upper side. This will be my targets for the downside. And it also gives me the information of implied volatility, delta, gamma, all these options, VIX, and it also gives me the fair value of options close near to this 5,950, which is 6,650, 5,900 and 5,850 call options, put options. So the two closest nearest strikes in the upper and down side, I am getting their fair value. I can compare this fair value with the market value, and if there is some arbitrage or mispricing is there, I can utilize that opportunity to do some option arbitrage trades. Suppose if I am saying that 6,000 call option which is quoting at 167 now as per its fair value, if in the market if I am getting that it is quoting at 197 or 187, so 10 rupees of excess value is there, it is mispriced by 10 rupees, I can think of selling that option, and that 10 rupees mispricing I can get it. So that process also, some options arbitrage trade also I can do. So how the performance of this trade tool maintains, I will be showing you certain contract notes of mine which can very well explain the performance of the tool. So you can say this is my own contract note. This is my own contract note. So this trade is being 5,900 call option, 927 entry, and the date of the trade will be 17th of September. 17th of the September, and exit was 3 o'clock 16 minutes. So it has 98. So 79 to 99, almost 20 rupees, 19 rupees almost gain it has given me. And also I will show you one more trade also. Many trade contracts, which is the closest nearest trade, also I am showing you those contracts, but I have many. So 10,500 call option, also 9 o'clock and 12 o'clock. It is on the 16th of September. This trade is being done. First it is being sold and it is being bought back. Given 1700 profit. And 5900 call option, same call option. 12 o'clock it is being entered, 2 o'clock it is being exited. 949 rupees profit. Same way of analysis. First I analyze the future. Based on that, I analyze that what is the current trend currently prevailing. Based on that, I have decided whether to buy a call option or sell a call option, or whether to buy a put option or sell a put option. So this is how you can do intraday trade in options.
So fine. So here the option pricing model which is being used for calculating these premiums is binomial option.